Everybody. Thanks for joining us today. We absolutely love having these end of the month webinars to give us some inside tips and tricks of the trades for our Kickstarter platforms. And today we get to meet with Seth Norris. And Seth, what's the name of your company? Because I was trying to read your shirt, but you kept
Yeah,
moving.
sorry, my mic's in the way. It's Norris CPA. Very creative, I know.
Very creative, but actually great branding because it's very easy to remember.
That's right. That's right.
So
We also bought authorcpa.com because we specifically work with authors. And so that'll eventually go to its own webpage, but right now it just redirects to our site.
I love that. Well,
Yeah.
and that's very fitting because many people on today and that will be watching when they receive the recording are authors. So we do
Yes.
have some other creators that come here from time to time, but
Oh, cool.
I think one of the questions we get asked all the time is about finances. So when we connected, I thought that this would be a really great opportunity for people to learn insights about their business finances, but also how do we tackle taxes? How do we tackle tariffs? How do we tackle some of the things that we might be coming face to face with when we're running a Kickstarter campaign? And just to reiterate, the Influence is not a financial advisor. So we do not love to give that type of advice because that's not where our expertise lies. So we're really excited today to hear from you and to hear all the wonderful things that you can tell us and just take it away.
All right. Sounds good. Before I jump in, I do want to tell a quick story. I work from home or in my business from home. Jessica, my wife, she's an author. She homeschools our five kids. So we're always home all the time. I like to have meals outside. It's quiet. We have these beautiful woods behind our house. And one day recently, I was having like a late breakfast, early lunch outside on the patio. And my youngest daughter, I think she's 9, she came out and she's like, Daddy, can I come sit with you? Just all sweet as can be. And I was like, well, yes, of course, come sit. It's like this picturesque moment. Her name's Mary Catherine, and Mary Catherine is what we would call here canaille in Cajun French, which means like very mischievous and very sneaky. So I figured there was
Okay.
something up. We have these rules around eating in our house because again, 5 kids, home all the time. If we just let them eat all the time, they'd be little hobbits and they would just eat everything all the time. So we have specific rules around like you can have any snacks you want anytime you want, except this long before meal times, this long after meal times. This happened to be one of those windows for her. So she's sitting next to me and she's looking over at my plate of food and looks back and looks at my plate of food and she says, Man, that sure looks yummy. And so I look at her and I say, Well, Mary Catherine, why don't you go inside and make yourself some toast if you want some toast? And she sighs, I can't. It's not 11:30 yet. And she knew, like, if she asked me for my food or if she asked if she could have an early lunch, she knew I'd say no, but she thought she could guilt me into it. And I bring up that story because I think we do the same thing as business owners. We're constantly trying to like bat our eyes at the IRS and find those loopholes and find those tricks that if we say things in just the right way, we won't have to pay taxes on some of this money we're making. So,
I
Mary,
would love to bat my eyes at the IRS and say, hey, buddy, any chance this year you could forget about little old me?
yeah, it might work for you. That wouldn't work for me. Uh, so I'm going to talk in this webinar just about setting up finances for a Kickstarter campaign. But I'm going to spend a lot of time talking about taxes and the right way to move things around for tax purposes that keeps you legal, but also maybe save you some money.
We like the idea of saving money.
Yes. All right. So I have a slideshow. Can I
Me.
share it?
Oh, yep, it should
Okay.
it should say.
I think it lets me.
Yeah.
You should see a blue and green, funky,
It's gray, but there it is.
wonderful. Cool. All right.
Love the background.
Thanks. Appreciate it. Thank you, Canva. So,
Yeah.
my name is Seth Morse. I'm a CPA, and our clients are self-published indie authors typically and other creatives who are trying to grow their author and creative businesses, but they struggle because they're either paying too much in taxes, or they don't understand their finances, or they just need more time to focus on their actual business and not mess with all the numbers all the time. My wife Jessica is an author, and we have this saying that like let Jessica cook. Just let Jessica do the things that earn Jessica money. And so if she's spending time poring over financial statements and doing sales tax and messing with her own taxes, she's not making money. She's making money when she's writing books, when she's designing cover stuff, when she's developing products from her existing IP. That's when she's making money. And so we realized that some of the same problems that she's having, we can solve for other authors and other creatives. So we started going to conferences specific to authors. And we've been working with them for a while now, solving those problems in their business. So for this specific call, we're going to talk about how to structure finances before, during, and after your campaign. And these are coming straight from those bullet points you put in the description. Only thing I did different was I like things in threes, so I took the second two and combined them into one. We're gonna how to handle income and expenses for taxes, and how to stay compliant and profitable. And if you're not seeing the slides progress, let me know, please.
Oh no, we are. Yeah.
Okay, cool. So planning, return on investment, that's what ROI is, and margin. In order to plan your Kickstarter, and this isn't going to be specific to taxes, and so I'm going to kind of gloss over some of this. Maybe you'll have me back later to do something more specific on this side of
I
things.
would love that. Don't
And
tease me with a good time.
and so we're going to figure out how to know your costs, how to calculate your break-even point, and how to adjust it if we need to. So you're going to have variable and fixed costs. Your variable costs are going to be per book or per item. Think of things like printing, fulfillment, the things that it's a certain dollar amount per item produced. And you're going to have fixed costs that are more campaign wide. These are things like design, narration, translations, anything that you might have to pay, even like maybe to manage the Kickstarter, that aren't going to change based on your income. It's a fixed amount whether you earn nothing or earn $1 million. And it's important to know those because those go into differently on how to calculate your break-even point. So your break-even point, there's two steps. You're going to take your sales price minus your variable cost, and that's what we call your gross margin. That is all the money you have available from every sale to cover your fixed cost and your overhead. I'm going to assume whenever we're doing this calculation that Kickstarter may not be the only way that you earn money in your business, and that maybe you do direct sales. And so like all your other overhead, your software subscriptions and all that kind of stuff is covered by other income. We're going to talk specifically about Kickstarter costs. So then you're going to take your fixed cost for your campaign divided by your gross margin, and that's going to get you your break-even point. So I developed a spreadsheet. I don't know if this is showing up on the screen share because I don't know if I shared it the right way.
I don't see the spreadsheet.
Okay, one moment, please.
I think, yeah, like sometimes you got to log out and then just reshare.
Yep. All right, here we go. I think this will work now. Let's move you over to a different monitor. All right, so you should see a spreadsheet.
Oh, this is great.
Okay, cool. So different pledge levels, prices, variable costs, and we're just plugging in some numbers here. So we assume, let's say like $25, 50, 100, and 250 for your different pledge levels. And printing could be anything. This would be maybe product cost, we'll call it, things to actually produce the product if you're not doing books. I'm just made up some numbers here based on percentages, but like let's say fulfillment is 1% of sales and management is 10% of sales. So then your total variable cost.
What's the management mean? Is that like,
Good.
is that like the labor of it or?
Yeah, so if you have somebody like the INKfluence who is managing your Kickstarter campaign or doing it for you and setting it up and maintaining it, then whatever fees are involved with that, sometimes those are variable costs as a percentage of sales. Sometimes there's a fixed component as well. So
Okay.
that would fall into that. So that your total variable cost, let's say, would be $775. And that would mean your gross margin here is $17.25. So every time you sell something at $25, you keep $17 of it. That gives you a gross margin percentage of 69%. So this would be super easy to do if all we had was one pledge level, because then we could just say, all right, if my fixed costs are say $5,000 and I have sales that each one is $17.25, I need to sell 65 units to break even. But we are going to have several pledge levels. And so we have to do some estimating and some assumptions on how much of our sales are going to come from each one of those pledge levels. We're going to assume a simple bell curve here, 20% at the bottom, 20% at the top, 30% each of the middle ones. And if we do the math on this, what you'll come out to is ignore the math here. But basically what we're saying is if the sales actually happen in this way, then if we were to take all the funding from Kickstarter and divide it by the number of supporters we had, the number of pledges, then we should come out to an average order value of $76.40. If that happens, and we have total fixed cost of $5,000, then we would need 65 orders in order to break even, just to cover a fixed cost, have no profit. And so you can use this as kind of a sanity check to figure out, like, am I close to where I need to be? Because this is what a poorly planned Kickstarter might look like. So this is a second tab, same thing, different numbers. I reduced the price, I increased the costs. And when you come over here, you can see that I'm actually making more money at level 1 than I am at level 2 because I haven't planned this correctly.
Yeah.
And so in this scenario, all the same other math, you need almost 1,000 sales just to break even. And so this is where numbers are so important because numbers tell you where to focus your attention. So then we start looking at what am I doing wrong here? Do I need to adjust my pricing? Do I need to maybe move some of the benefits down to a different level to make them more valuable and raise the price? Do I need to add in some low cost, high value items? So
Mhm.
that's how I would use this. Um, One soapbox rant on gross margins. I fully believe that as you move up in price, you should be making a bigger percentage margin. I do not believe that you should be squeezing your margins as you get higher and higher in price point. And don't get fooled by, well, I'm making $11 here, but only $3 here. Yeah, but you're only keeping 9% of every sale versus 39% of every sale. Uh,
Right.
I think your customers, your readers, your clients, whoever they are, they want you to be profitable and they deserve for you to be profitable. We follow a book called Profit First by Mike Michalowicz and all the stuff that we do with financial management with our business and with our clients. And Mike was on an interview where he said, imagine you're having open heart surgery and you're talking to your surgeon the day before, you've gone through all the consult stuff, and now you're just kind of shooting the breeze. And you ask, how's business? And your surgeon puts his hand in his head and he says, oh, it's not good. I just have to let go of 3 office staff. We're closing a location. I don't even know if I'm going to be in business next year. Like, are you comfortable going into that surgery the next day knowing that he's worried about buying groceries and paying his mortgage? But on the other hand, if you go into that same consult and you ask, how's business? And your surgeon says, business is great. We just hired 3 more physicians. We're opening a new location. My husband just I retired him from work and now I'm taking a vacation at our beach home next month. Like you're much more confident going into that surgery because you know that she's not concerned about anything other than your procedure. So even though maybe the things that we're selling aren't life or death situations, our customers, our clients, and our readers still want to know that our attention is on them whenever we're producing and selling a product, and they want and they deserve for you to be profitable. So that's my soapbox there. Move that over here. Okay, so next, how do you fund this? Now that you know how much it's going to cost, how are we going to fund it? There's 2 ways to fund any kind of business growth, through debt or through equity. Another word for equity is just investment. Now, the thing is, debt is easy to acquire, but debt equals risk. I am not by any means a Dave Ramsey absolutist. I do think that there are some good forms of debt, and I do think that there is a good way to do debt, but debt does add risk to any equation. I was a CFO of a bank for 5 years. And so I was responsible for all the finances of the bank and for helping come up with loan interest rates and deposit rates and everything else. I know from the bank's perspective that whenever a bank lends us money, they're taking on risk. And so the bank has things in place to mitigate their own risk, whether they're vetting you for credit or if they're raising your interest rate so that you have to pay more upfront or they're changing your payment terms. The thing is, they have all these things in place to protect them and move that risk to us, the customer. All we have is the DocuSign they sent us and probably more access to credit than we should actually have. So just because we can qualify for a loan doesn't mean we necessarily need to take the loan. And I'm curious to know if there's anybody here in the chat, if anyone has ever taken on debt that later has haunted you, like take on debt, no, I'll be able to pay this off in 6 months before the 0% interest period expires. And then 6 months comes and goes and it didn't happen the way you thought. So I'll wait to see if that comes up in chat. But while that's coming up, I'll talk about the investment sources. So if you don't want to use debt, how do you fund this? You can use your existing book or your existing business to do this. So let's say you've decided that your upfront costs are going to be like $1,500 and you're earning about $150,000 a year. Well, set aside 1% of your sales for 12 months or 2% of your sales for 6 months, and that funds your Kickstarter campaign. Maybe you need to invest personal funds, or one that I really like is to do like a mini Kickstarter campaign. Do something really simple and fun for your first Kickstarter with the sole goal of having the money to run your next big Kickstarter, the one that you really wanted to do. You don't have to jump in with the kitchen sink all at once. We have stuff in chat.
Yeah, just that we agree.
Yeah. All right. So how do we set this up? Like I said, I followed Mike Michalowicz's Profit First system, and we help our clients implement this in their businesses. But what Profit First does is it says if we're making business decisions, we're not going to the financial statements. We're not going to a P&L. We're not going to a cash flow statement. We're looking at our bank account balance and we're seeing, do we have money to do something? And if we have the money, we're doing it. If we don't do it. We're doing what we call bank balance accounting. And so under the Profit First system with our regular business, we're setting up over here several bank accounts for different purposes: taxes, owner's pay, profit, operating expenses. But I'm going to go a step further with Kickstarter, and I'm going to have clients set up several more bank accounts specifically for their Kickstarter. And I know the idea of having like 10 bank accounts makes people really, really itchy, but I'll show you a bank account that I like to use for this kind of thing that makes it easy. But the bank accounts that I would have, these are buckets. I would set up like an income bank account. This is where all the funds from your Kickstarter are going to come into. And then I'm going to take the money in the income bucket and I'm going to allocate it to these other buckets. So I have one bucket with variable costs. I should know the percentage of variable costs from that spreadsheet. So if I know that my variable costs are 30% of sales, I'm going to take 30% of what's in my income bucket and put it in the variable cost bucket. Then I should be able to figure out my fixed cost percentage. I'll put aside 15% for taxes and I'll put money in a profit bucket. That money in that profit bucket is not to be spent on overhead expenses. That's the whole idea of profit. We want this money to be left over. We want to choose to be profitable because we believe that profit is a habit, not an event. It's something that you do. It's not something that just happens to happen. So what do we do then with that profit? You could either invest it into your next Kickstarter campaign. You could invest it in your business for some other thing, maybe software or a course or an employee or whatever that's going to help grow your business. Just make sure that you're tracking the return on that investment whenever you do that. Or maybe you have a very seasonal business like a lot of my authors do, and you need to use the funds from your Kickstarter to help level out all those slow months. And so we need to be very strategic about how we drip that out across the rest of the year.
I have a question about
Yes.
that seasonal. And by the way, Amanda is loving your spreadsheet. She sent me a message,
Oh,
private
good.
message that said she's very excited about your spreadsheet. I said I'm a little overwhelmed, but she loves it. So seasonal, is that something that you find, and you probably don't know this for Kickstarter. I could answer it more for Kickstarter, but in general, do you find that authors there is that seasonal? Is it more like Q4 is really high and Q1 is like, I don't know what, I would love to hear what that is. And then I could answer, because I'm sure
Mhm.
people will have that question when they're watching this. Is there a season for Kickstarter?
Absolutely. So outside of Kickstarter for authors and for most creatives, a lot of times you're going to see an uptick in sales and holiday sales towards the end of the year. You might see, depending on your genre, some stuff for the summer just because of summer reading things, but typically we see big dips in the summer because people aren't sitting at their desks scrolling through Facebook and seeing the algorithms. They might be outside actually doing things. So
Yeah.
we see that. I used to work with a lot of photographers, and a lot of photographers don't see a whole lot of sales in the summer if they're doing wedding photography because it's too hot, especially down here in Louisiana, to get outside and be shooting those things. So they see summer slow months as well. Same thing with my business. Like obviously tax season is busier than other parts of the year. So it's very
Yeah. Does your
important that,
family even see you during tax season?
well, so yes, we have built this to do both. I think I really believe, and I actually want to talk about this later, that it is possible to do both, provide for your families and be with your families. I don't think we need to
Yeah.
wait for that. So,
Well, and I'll answer the question for Kickstarter. Kickstarter is somewhat similar. Q3 and
mhm,
Q4 are the biggest months. And Q1 is actually, I take that back, the beginning of Q4, about November, December, where you see a high, um, intake of sales. It's
mhm.
quite slower on the Kickstarter front because they're not immediate products that we're receiving. There's a wait time for it. So the
Interesting.
end of Q2 to Q3 is the best, and then the beginning of Q4, and then it kind of peters off until Q2 ends again.
That's interesting. So then you can use Kickstarter to help fill in those slow months where it might be slow with your, quote unquote normal business and use
Yeah.
Kickstarter to supplement the slower months.
Yeah, like summer is really good on Kickstarter into the
Yeah,
fall. I love
interesting.
that.
Very good to know. All right, so that is all for setting up, planning your Kickstarter. We're going to get into taxes for the rest of this if we're ready for it.
Yeah, I'm ready.
Okay. So with taxes, timing is everything. Income is taxable when it's received. Things are deductible whenever they're spent. So what does it mean to be deductible? A deduction is just money you can subtract from your income to pay less taxes on that income. So if you earn $100 of income and you have $30 of deductions, you're going to pay taxes on $70 of net income. So that's what taxes are applied to. Let's say you receive money in 2025. Let's say your Kickstarter funds and everything, and you get the payout December 31st, 2025. But you don't go order the inventory or pay for the production costs until the very next day, January 1st, 2026. Even though there was only a 1 day difference between receiving the money and spending the money, you're going to have a 1 year difference on the tax benefit. So the money you take in 2025 is going to be taxed on your 2025 tax return that you file in April of 2026. The money you spend in 2026, even if it's January 1st, is going to be deducted on your 2026 tax return that you don't file until April of 2027. So that could work against you if you're not paying attention to it, but we're going to go over some ways to actually make it work for us whenever we're planning out our campaigns. What are some things that we can deduct? So again, deductions are just things that reduce our income, so it reduces the amount of income we're taxed on. The IRS says that you can deduct anything that is ordinary and necessary in the course of business. So production costs, anything for designing, editing, narrating, translating, printing, anything involved in bringing the campaign to life and delivering it to the customer is an ordinary and necessary expense that can all be deducted. You can deduct the home office deduction, so you can deduct your home office expenses, but I would just be very mindful about how you do it. There's two different ways to do it. There's an actual expense method and a simplified method. I can get into the details during the Q&A, but the actual expense method lets you deduct a percentage of all your home's expenses, but it also requires you to pay taxes on some of the sale of your home whenever you sell the home. And so be careful of that, because in the simplified method, it's a lot easier to do it. It sometimes isn't as sexy because it may not be the bigger deduction, but it'll save you on taxes later when you sell your home. Contractors and third parties, that would be like if you hired Dana, if you hired me, if you hired somebody else to do something for you, then you can deduct all those expenses as long as what they're doing is business related. Just make sure that you get a W-9, which gives you the information you need to file a 1099 later in the year. Equipment like computers, desks, anything that you use for multiple years. The default with these is to usually deduct them 100% in the year that it's purchased, but we may actually want to not do that depending on the timing of when we want that deduction to land. And I'm going to talk about that when we get to the tax planning section. And I put research, especially for the authors here. Be very, very careful about personal use things that you use for research. So I know a lot of authors like to say, well, I'm writing a book with a beach scene in it, and so I'm going to go to the beach and spend a week there, and it's a research thing, so it's deductible. But man,
What do you mean, Seth?
I have a court case. It is my favorite court case, and I don't know if anybody else has favorite tax court cases.
No, that's a you thing.
Just me, okay. There was an author who was writing a book, and the main character in the book was frequenting brothels. And so
Oh,
this author decided he needed firsthand experience on what that looked like. And so he went to Las Vegas, he found legal brothels, and he frequented them, and he took notes, and he interviewed, and he actually had notebooks that showed this interview with this person ended up being this character over here in this book or whatever. The IRS audited him. They actually allowed the travel expenses to Vegas because they said he could very clearly document that the trip was specifically to research his book, but they specifically disallowed the payments to the brothel because they said that he got personal use out of that payment. And so
huh.
because it was personal use, it automatically disqualified what otherwise would have been a business expense. So as soon as we use something for personal use, it's no longer a business expense, even if we did it specifically for business purposes. So just be very careful with research stuff. And then, of course, professional fees, like your accountant, are always deductible.
That's cool.
Compliance and planning. So one of the questions I hear a lot is Elaine
We
says she
we
has
have
a,
a
yeah.
couple of questions, but is this a
Okay,
good
sorry.
time? Could we ask them before?
No, this is a perfect time to ask.
Okay. So hold on. Oh, well, this one says, is the margin spreadsheet available as a template?
Yeah, absolutely. I can send it over.
Oh, great. That's very
Yeah, yeah.
sweet. Thank
In
you.
fact, what I'll do is If I can get an email address, then I can send it. I also have a newsletter. I don't think that it's on, tell you what, if you give me your email address, I'll find a way to get it to you.
Well, we could send it to everybody we always do a follow-up with the
Perfect.
answers to the questions because we have 18 questions from audience members that wrote in.
Oh,
So
cool. Okay.
we do have those, and then if there are any questions in the chat, we normally answer those, and then we have the 18 that we got prior to this. There's
Perfect.
a lot of people that can't come during the day, so they send their questions in, and
That
then
makes
we
total
answer
sense.
them, and they can rewatch it, and their question will be
Okay.
answered. And then
Yeah.
I actually had a question for you too. So I'm curious on your thoughts that you talked about like December and January, like being mindful of payments in the
Mhm.
end of December into January. I recently changed my end of the year to June, July. I think it's
Yeah.
June. So July. Any thoughts on that and or suggestions?
Yeah. So you're talking about most taxpayers, your specifically default going to be calendar year. So
Yep.
your year ends in December, starts in January for those reasons. Some people, like you just pointed out, you can elect what's called a fiscal year, where your tax year actually starts and ends on a different month out of the year. There are reasons to do that, maybe specifically for that reason. If you have a lot of income coming in December and expenses related to that income in January, and you just want them to be within the same tax year, that would be an excellent reason to do that. Uh,
Yeah.
you also have the benefit of a little bit of foresight whenever you do it that way because you're operating under the tax laws that were in place at the beginning of your tax year typically. So if you're going to file a tax return that goes from July 1st to June 30th, you're going to base your tax laws on whatever they were for July 1st, like you're filing a 2023 or 2024 tax return. So you get a little bit of foresight to know what's happening with those tax laws.
Yeah. And we do that because of Chinese New Year. So like our year ends with China.
Oh,
So
that's really cool. Oh, that's right, with all the shipping and everything else.
yeah.
Nice.
But thank you. I was
Yeah, it's a
super
great
excited to ask
question.
that question.
It's a great question. It's not something that you can really like, or that you would want to change back and forth and back and forth and move it
Nope.
around. So once you make the change, you want to kind of be sure that you want to do it. But like, yeah, if you've decided that it makes sense for you and your business model, then it can be very beneficial.
Yeah.
What else we got?
Oh, Elaine said your newsletter is
Oh,
awesome if you're not on it.
oh, thank you, Elaine. I appreciate that. Anything else before we keep going?
Nope, I'll ask the 18 written in questions at the end.
Okay, perfect. So one of the questions that I see going around Kickstarter communities is what income is taxable income? Like if I don't get a 1099, if it's under a certain dollar amount, if it's from a certain platform, is it taxable income? The answer is all of it. It's all taxable income. The IRS says any income from any source is considered taxable income unless it is specifically excluded in the tax code. So it doesn't go the other way around. It's not that if the IRS doesn't say anything, it's not taxable. It's the other way. If the IRS doesn't say anything, it specifically is taxable. And one specific thing that keeps coming up with Kickstarters is donations. Well, these aren't sales, these are donations. They're just supporting our business and we're sending them a free book or a free gift in exchange for it. But the IRS would specifically disagree. So there is on irs.gov website. IRS reminds taxpayers of important tax guidelines involving contributions and distributions from online crowdfunding. And a quote from that document is, if crowdfunding contributions, so your pledges, are made as a result of the contributors' detached and disinterested generosity, so they're just giving you this out of the kindness of their heart without any expectation or without receiving anything in return, then it may be a gift and it may not be included in gross income for tax purposes. But if your supporters are not just giving you money out of the kindness of their heart, and if they expect to get anything in return, even if like you're just sending them a nickel and they give you $100, this doesn't say that there's any consideration given into the value of what's given versus how much they pay. If they expect to get anything in return, it is considered gross income. It is taxable. This whole carve out is specifically for things like GoFundMe. So you've got a
Okay.
brother-in-law who got into a bad car accident and got to feed 6 kids and he's out of work for 3 months or whatever. And so you raise a bunch of funds and people aren't getting anything. That's not taxable income generally. You have a business where you're trying to sell things, there are no tax loopholes that let you get out of paying taxes of business income. There's ways that we can structure things in a way that make you pay less taxes, but there's no secrets that the IRS doesn't want you to know about. And there is no lack of people online and people influencers saying just ridiculous wrong things about taxes. And I think a lot of it is actually intentional. I think what they're doing is they're saying these things that are just blatant tax fraud, knowing that people are going to stitch those reels and reply to them and put comments, and it's going to get them engagement and it's going to raise their viewership. And so then they can go sell you the course that they're trying to sell you. Grant Cardone, I'll throw him under the bus. Grant Cardone is famous for this. He just says the most
Yep.
ridiculous tax things that just are flat out wrong, or maybe they're leaving out some very important context. And it infuriates me. Like, we're all about
I,
giving more information to people, not bad
I
information.
think all of his sound bites are like that. Like all,
Hmm.
I mean, that they feel they're all very fish hook, you know?
Yeah, absolutely. Like, one example was he talked about buying this Range Rover for $100,000 to drive it out onto a stage for a conference at the end of the year. And he wrote it off on his taxes, and then he went and traded it in the next day. And so he got it for free, basically. But he left out the part that once he traded in that vehicle, he created a taxable event there. So it offsets the tax benefit. And the IRS would even question whether or not that was a deductible use of the vehicle anyway. But like, he says it as if it's some mind-blowing loophole that he just found because he's just smarter than everybody else. And not a fan, if you haven't been able to tell.
No, no, I caught on.
Okay. So if we can't do that, if we can't hide things from the IRS, if we can't trust Grant Cardone, how do we save money on taxes in a legal way? We can speed up when we pay taxes and we can slow down when we pay taxes. So I'm going to come back to this slide, but first let's go back to this timeline slide. Am I still sharing? I think I'm still
Yeah, yeah,
sharing.
yeah.
Yeah. Okay. So when money's received, when it's spent, we can actually use this to our benefit. Most taxpayers default as cash basis taxpayers. So again, you pay taxes when money's received, you make the deduction whenever it's spent. But you can elect to be an accrual basis taxpayer. What that means is you only pay taxes once funds are earned, and you only deduct expenses once they're incurred, regardless of when cash changes hands. That's typically not a great strategy because you can't do that from year to year, just like changing your tax year. You can't just flip back and forth between cash and accrual. But depending on how your business is set up, it could possibly make sense, especially if you're very inventory heavy, to possibly be accrual basis. If you're purchasing a lot of inventory for resale and you're holding large amounts of inventory and your tax brackets are consistently going up every year, it could actually make sense then to push that deduction into future years rather than whenever you're paying for the inventory. Another thing you can do that's more accessible to more people is like with the equipment purchases. So let's say you buy a multi-$1,000 MacBook Pro, whatever, or iMac with all the peripherals and everything else. Those types of assets typically are supposed to be deducted over several years. But there's provisions in the tax code like Section 179 and bonus depreciation that let us deduct those expenses 100% in the year that they're purchased. It's so easy to do it that most tax software is going to default to that 100% deduction in the year of purchase. But there's some situations where you may actually want that deduction to go into future years. So for example, if you're running your first Kickstarter and you're just getting your business off the ground and you're planning that for 2026, but you have these equipment purchases towards the end of 2025 and you don't really have any income to deduct that against, or maybe your income bracket, your tax bracket is going to be lower in 2025, you might actually want to forego deducting that equipment in the first year so that you can take advantage of deducting it in 2026, or at least a portion of it in 2026 when you expect to have a higher tax bracket. Because the way the tax brackets work, the more income you make, the higher percentage of your income is paid in taxes. So if you're on a low income scale, you might be paying 10% of your income in taxes. If you're on the high income scale, you might be paying 30 or 40 or 50% of your income in taxes. So you have to plan for your tax brackets. The other way that you can do this, another very accessible way, is, you know how like all these subscription services give you the option to do an annual payment and you get a little bit of a discount? That may or may not be worth it. So where it might be worth it is if you're trying to get a deduction in 2025, look at all those monthly subscriptions and see if there's anything that's available to do an annual subscription towards the end of 2025 so that you bring in some of those deductions from 2026 into 2025. Or vice versa, if you're currently doing an annual subscription and the renewal is coming up in 2025, but you realize that your income tax bracket is going to be higher in 2026, you might forego that discount for paying up front and instead pay it monthly throughout 2026 if your tax savings is going to be greater than the discount you get for paying it up front. So reasons and why to do either one. So when should you speed up taxes? Like when would you want to hold off on deducting something? If you expect your tax rate next year to be higher because maybe you're being a higher tax bracket because you're earning more, or maybe your marital status is changing. Tax brackets are based on marital status. If you're filing single, you're going to have higher tax brackets than if you're filing married. Or tax law changes. This is going to be a really big one this year. There are a lot of tax deductions expiring this year. I can almost guarantee that anybody watching this call, if these tax cuts expire and Congress does not pass something to extend or replace them, I can almost guarantee that everyone is going to see higher taxes in 2026, even if everything else stays the same. And so if those tax deductions expire, you might find yourself in a higher tax bracket in 2026 and then need to, or find a reason to move deductions over to 2026 whenever they're worth more because they're deducted at a higher rate. So another teaser for later, maybe once we know what the tax laws are going to be next year, we can come do like a tax update webinar towards the end of the year, Dana.
Yeah, I think we have to. Now I'm scared.
Or what if you have tax credits expiring? So our youngest son, Jude, we adopted him from China, and whenever you adopt a kid, you get a adoption tax credit. That tax credit can only be used to offset actual taxes owed. It can't create a refund, and it expires after 5 years. So if you don't get to use it because you don't have any taxes owed, then it just goes away. You don't get the benefit of it. So if I have an expiring tax credit expiring this year and I have an opportunity to move expenses into next year so that I create a tax liability for myself this year, then I can end up using up that tax credit that otherwise would have been useless. And I still get to deduct those expenses next year. Or if you're trying to qualify for a mortgage or a loan, the bank, especially if you're self-employed, they're going to want to see tax returns and financial statements. And my time at the bank showed me that there's so many people wanting to pay no taxes, no taxes, no taxes until they need a loan. And then by then it's too late because they don't have any history to show that they made any money on paper. And so now they're not able to qualify for a home mortgage or other kind of loan. So that could be important as well. On the opposite end, when might you want to slow down taxes? So when might you want to bring deductions into the current year so that you pay less taxes now, but maybe pay more taxes later? If you're expecting a lower tax rate next year, basically for all the opposite reasons of the point in the first part of the slide. Or if you're just expecting everything to stay the same, if you think your income's going to stay about the same, your tax rate's going to stay the same, the tax laws aren't going to change, then there's a time value of money there. A tax deduction now is typically worth more than a tax deduction later. Because if you can save, let's say, $10,000 in taxes this year and instead have to pay that $10,000 next year, then why don't you take that $10,000 and put it in a savings account and earn a little bit of interest on it, or pay off some high interest credit card debt and really make a big return on that. So use the time value of money to your advantage. Sales tax. I know this is a dumpster fire as indicated by the little graphic here. I know there's a big question. Do you owe sales tax? Probably. And actually, that's a misnomer. You don't owe sales tax. Your customers probably owe sales tax. So all the stuff we just talked about is income tax. That's your tax. That's your expense for the money that you made, you owe the government. Sales tax is different. Sales tax is actually your customer's tax. You're acting as middleman for the state departments of revenue and the local departments of revenue to collect that sales tax from your customer and then give it to the government on their behalf. A lot of states actually have a thing on their annual income tax return that asks individuals, how many purchases did you make and you didn't pay sales tax on because they were online purchases? And then we'll send you a bill for the sales tax you owe. Now, who's going to actually report that to the government voluntarily? And so what the government rather do is they rather collect it from the businesses that are selling the products because then they can penalize the businesses into submission to do this for them. So where do you have to collect sales tax from your customers? It's going to depend on nexus. Nexus just is a fancy word that means connection. You can have a physical nexus or an economic nexus. Physical nexus is easy. If you're located somewhere, you have a physical nexus. If you have a distribution center somewhere, you have a physical nexus. Economic nexus is a little bit less easy. That is, you have so much economic activity, so many sales in a certain area that you're considered to have a connection there and be required to collect and remit sales taxes. Used to, that was super ambiguous. There was a case with Wayfair, the online shopping
Oh
thing,
yeah.
where they went to the Supreme Court or whatever, and it established some precedent for what's considered economic nexus. And it's roughly going to be $100,000 in sales to a particular state that will establish nexus. The issue is every single state is implementing that differently. And some states are saying it's a calendar year, $100,000. Some states are saying it's a rolling 12 months, $100,000. Some states are saying it's lifetime 100,000. As soon as you exceed 100,000 in sales, you now have Nexus here. The issue is going to be that you have to, and once you start getting to that level of sales, you're going to have to start identifying those states where you have like a concentration of sales and start learning that state's sales tax laws to figure out one, what's even considered taxable for sales tax purposes, because that changes from state to state. And then when are those taxes due and how are they paid? To make it more complicated, you also have individual counties, or like in Louisiana, we have parishes that have their own sales tax laws that are sometimes different from the state laws. So it is a dumpster fire. You definitely need to be collecting and remitting sales taxes for any sales that you're making to people within your home state and possibly home county. And if you have any kind of distribution center in other states, you probably have physical nexus there and need to be collecting and remitting sales taxes for sales within that state. So like if you have a distribution center in Texas, then you have Nexus in Texas, you have Nexus in Texas.
Texas
Then,
Nexus.
then you have to collect and remit sales tax there. Uh, I correct me if I'm wrong. I think Kickstarter's pledge manager now will collect and remit sales tax for you. I'm sure they're charging a fee for it, but if you don't feel like going through all the stuff that I just talked about, it's probably well worth the fee because you can use services like Avalara, but they're going to charge you a few $100s for every single sales tax return that's filed every single month. So
Right.
I
Pledge
really recommend.
Manager is allowing you to collect the sales tax um, on behalf of your backers.
And am I right that I think the pledge manager is going to act kind of like a marketplace the same way Etsy would? They're not going to just collect the sales tax and then say, okay, Dana, now you go send it to this state. I believe they're actually collecting it and they're remitting it and filing it for you to where you literally don't have to do anything.
That's correct. They are remitting
Okay.
it. Amanda, anything else about that? You might know more than me.
No, I mean, that's the gist of it. Like, you have to work through the pledge manager setup as far as like your tax codes, which are like location based, very similar to like any e-commerce site. But then, once it's all set up, it is collected and remitted, and Kickstarter handles all of that for you. But I believe it is only currently if you reside or like, your business is set up in the US and I think Canada right now. Canada, I'm not 100% sure on. And then if you live anywhere else, they're slow rolling out later this year, hopefully other tax locations for it.
Perfect. Yeah. And I see Elaine just messaged, have they figured things out when we live in the US, but our books are shipped out of the UK? Kickstarter specifically, I don't know if they have anything like internally that'll take care of that. I'm imagining talking about like VAT and tariffs and things like that. That's also going to be very specific to the country you're selling to. I think that there are services out there specific for UK or EU that will take care of that for you. But yeah, that's a whole other rabbit hole. That could be a whole other webinar. All right. So before we jump into the Q&A, I think we have a little bit of time left. I just want to talk. So this is how to find me, authorcpa.com. My Instagram. So my 16-year-old daughter saved me. I was typing out like Instagram.com/Norris CPA. She's like, Daddy, no, just put @Norris CPA and they'll know what to do. It's like, okay, if you say so. And then again, like I said, my newsletter down there, if you click that, if you go to that link, it will take you to my newsletter. Or take you to the sign up page for the newsletter. But
And we're gonna take all of this, and when we send the recap out, we'll have all of it in there.
oh, perfect. Thank
The
you. I appreciate
answers to all the questions that were asked get put in there and summarized, and then we'll put your contact information. And then this webinar will live on our site, but I know we only have a little bit time left, but I still have a bunch of questions if
Yeah,
that's
yeah, yeah.
okay.
Absolutely. Absolutely.
Perfect.
Let's go ahead and jump into those.
Okay, great. All right. So you answered a lot of these 18. When do I actually report Kickstarter income? When funds are received or when rewards are fulfilled? You said when funds are received.
Yeah.
Is that correct?
That's correct. Yes. When funds are received, and you may actually get a 1099 for those funds in the year before you receive them if it's close to the December cutoff. Like if whoever's organizing your Kickstarter receives funds from the backers, but they just haven't distributed those funds to you yet, you may actually receive the 1099 for that, even if you haven't gotten the funds, but you should be getting them soon after.
Okay, that's amazing. What expenses can I deduct from my Kickstarter income?
So that slide, I can bring it back up with all the deductions, anything ordinary and necessary in the course of doing business. So anything that's needed for, here we go, this one here. Anything needed to bring the campaign to life, to deliver it to the customer, printing, shipping, translating, narration, production cost, anything like that.
Okay.
Some home office deductions, we can talk about that if there's questions specifically about that. Contractors and third parties kind of make me mad sometimes, not the contractors themselves, but the way that is deducted, because like if I hire somebody to come to my house and watch my kids so that I can work on my business, that's not a business deduction. But if I hire somebody to come do the tasks that I would have done in my business so that I can go watch my kids, then that suddenly is a business deduction. But
Right.
whatever, that's the IRS. So
Okay. We're just going to copy all of this and add that because I think that's perfect.
all right, cool.
Research professional. Okay, perfect. Um, do I need a separate bank account for my Kickstarter funds?
You need so many separate bank accounts. You don't need the bank. So compliance wise for the IRS or legally or whatever, no, you technically don't need the separate bank accounts. But I super recommend multiple bank accounts just to make it easier for you to manage. So again, we all do bank balance accounting. We're not looking at financial statements. We're not looking at cash flow statements. I don't look at financial statements to make decisions. I look at my bank balances. And so what we do is we use bank accounts to reverse engineer what looks like a healthy business so that we make better decisions that aren't based on money that really belongs to the IRS or money that really belongs to somebody else. We're actually making decisions on the money that we actually have available to us. That can get super itchy to create all those bank accounts. People don't like that sometimes. And
Yeah, to me, that sounds icky.
so Relay Bank, it is my bank of choice that I
Okay.
love using. I use it for my own business. I use it for my clients. It allows you to set up several bank accounts here. So it's as easy as clicking add account, giving it a name, and now you have a new bank account. And the best part is that there are automations built in where you can tell it, hey, every Monday, I want you to leave $1,000 in the income account and transfer the rest to these bank accounts based on these percentages. And you can set those up automatically. So like if you've decided that you know your direct cost or your variable cost for producing your Kickstarter is say 30% of what you've received, well, you can have all the funds you receive have 30% of that go to a variable cost account. You can have 15% go to your tax account. You can have whatever your sales tax rate is, go to a sales tax account. That way you're allocating the money in advance, and then you can go at any time and know that you've already set that money aside for that.
So, a question on this,
Uh-huh.
is this the bank or is this an app that you could use for like integrating to your QuickBooks or something?
This is the bank with an asterisk on it. Fine print. Relay is a financial technology company, not a bank. So
Okay.
they provide banking services through a bank called Thread Bank, but Thread Bank owns Relay, which is like the financial tech. So if you're using like Venmo, Venmo is not a bank. Venmo is fintech, financial technology. But Relay is backed by Thread Bank, which has all the FDIC coverage. I actually have up to $3 million FDIC coverage and everything else. There's no monthly fees unless if you want to pay for like faster ACH or whatever, but you can actually have it with no minimum balances and no fees each month. It does connect to QuickBooks and Xero to make the accounting easy. And
Okay.
you can sign up just by going to relayfi.com. If you want an easier time setting up, I do have access to kind of a fast track setup process. But if you do use my link, I do get like a little whatever it's called affiliate thing
Yeah.
for that. But We have access to a lot of our clients' Relay accounts, which makes it really nice for us is we can just, with one login, click back and forth between client accounts to grab bank statements, to look at transfers, to set
Yeah.
up a profit first for them. So
Can
Relay is
you
good. Good.
can you use like Wells Fargo or any bank that you have with Relay? It doesn't have to be the bank that they own, right?
It does have to be the bank they
Oh,
own.
it does.
So yeah,
Okay.
it acts as if it's a whole separate bank. You can't like put Relay as the user interface on top of another banking platform.
Too bad. What a great like
Well, I know that would be cool, wouldn't it?
it would
If
be.
there was an app.
Somebody here should do this.
If you're doing profit first, that I've talked about a few times, they did just release an app. It's very okay. It still
It's
sucks, has
very
some,
okay.
it's still got some bugs to work out, but it will do kind of like what you're talking about. It will link to your banks, and I believe for some banks, you can actually initiate transfers from within the Profit First app and put things in buckets that way. But I don't have a ton of experience with it yet.
Okay. That's awesome. I love that. We wrote all of these down. If you want to put the link, your affiliate link in the chat, we'll add that to
Oh, thank you.
the email.
Okay.
How much should I set aside for taxes from the money I raise? Is there a percentage?
15%.
15%.
How easy is that? That's a good starting point. Your percentage might
Yeah.
be higher, might be lower, but if you look at the money you raise minus the expenses you have, your actual tax rate is probably going to be closer to 30 to 40% because it's going to be subject to your personal tax rate plus your self-employment tax rate, which is another 15%. But instead of having people sit there and try and figure out like what their actual taxable income is every time they get paid, it's easier just to say, well, instead of taking 30 to 40% of your net taxable income that you don't know what that is, let's just take 15% of the gross income before expenses, and that
Okay.
probably gets you close.
Okay. That's easy. I like that. I like easy.
Me too.
What are the biggest financial mistakes authors make during or after Kickstarter?
As it relates to taxes, I would say not setting money aside for taxes, spending all the money, thinking that they have all these tax deductions, and since they spent all the money, they shouldn't have any taxes owed. And then they get to tax time, and their accountant says, "Guess what? You had a profit of $10,000. You owe 2,500 in taxes." And the person says, "Great, I'll just take the 2,500 from the 10,000. Just let me know where it is." And the accountant's like, "Haha, you don't have it. You already spent it." It's just an
Right.
accounting process, profit. So I'd say biggest, easiest avoidable mistake is just setting aside money for taxes and preparing for it. That's your best tax planning you can do.
Do
And
you, and this is kind of a general question for all your, like what you tell your author clients, but do you encourage them to pay quarterly taxes?
it's going to depend. So a couple of years ago, I was telling almost everyone not to pay quarterly taxes because the interest rate and the penalties for not paying quarterly were actually a lot less than the interest that you can earn on that money in a savings account. So like, you
Huh.
could earn 4 or 5% interest by putting your money in a high yield savings account, but you might come up with like a 3% penalty for not paying quarterly. Um, Now the interest rates from the IRS and the penalties have increased, and the interest rates that you can get at the banks have decreased. So it's gotten to be more equitable or against you, I guess. Um, but it's still going to depend. So on your specific situation, there's two things to consider. There is a minimum amount you have to pay quarterly in order to avoid underpayment penalties for not paying quarterly. But then there's also the concept of even if you're not going to have a penalty, you might not want to have a huge tax bill to pay all at once. So it's just also from a behavioral standpoint. So you have to look at your specific situation. If it's something that you're concerned about, pay quarterly, but also make sure you're not giving the IRS any more money than you need to, because then you have to worry about getting that money back whenever it's time to actually file your taxes.
Okay. That was great. Um, okay, we answered that one. What's the best accounting software or tools for tracking Kickstarter income and expenses? Is there one that you recommend?
A good bank account helps with that. If you have your banking set up, it's the easiest way to do it. You can use QuickBooks. QuickBooks is great, it's fine, but it's kind of like McDonald's. Like everyone uses it, but it's not good. Um, they just have really good marketing teams. Their customer service is worse than talking to the IRS. So QuickBooks is okay, but if you can stay away from it for a while, I would. YNAB, YNAB, it stands for You Need a Budget. It's
Okay.
actually personal budgeting software, but it can be used for business budgeting as well. And it allows you to set up buckets and transfers. And it's one of the easiest ways to actually like plan for the money you get.
Okay. I use QuickBooks. Well, I use it with my bookkeeper,
Hmm.
but I don't understand it. So,
You shouldn't have
uh,
to.
no, no. Do I need, oh, yep, you answered this, but I'm going to just, because it was a question. Do I need to send 1099s to vendors, artists, or freelancers I hire for my campaigns? And if so, is there a monetary threshold? You did say yes, but I don't know if you answered if there was a monetary threshold.
Yes. So anyone that you pay for services more than $600 in a calendar year should get a 1099,
Okay.
unless if that person is set up as an S corp or a corporation, then you don't have to give them a 1099 because the IRS is assuming that if they're at that level of business, they're paying their taxes anyway. But like somebody who's just a partnership or a Schedule C, you should have to give them a 1099. And the only way you're going to know what their tax entity is if you get them to fill out a W-9. So it's a good standard approach to when you hire a contractor as part of the onboarding process, get them to give you a W-9 so that you have that information up front. And it's also kind of a way to indicate to that person, hey, I'm going to be giving you a 1099 on this, so you will be paying taxes because
Right.
sometimes contractors are surprised that they have to pay taxes too.
Yeah. Which is funny.
Yeah.
That's perfect. That's good. That's what we do the same thing. How should I handle international backers or fulfillment partners in terms of taxes with Kickstarter?
The I'm assuming they mean sales tax or VAT, not income tax. For income tax, it's all taxable. It doesn't matter where it comes from.
Okay.
And again, sales tax, VAT, things like that, that's going to be dependent on the customer. It's going to depend on where they are, and it's going to differ everywhere they are. So some provinces in Canada have like a $0 threshold. The first sale is subject to VAT. Some countries have higher thresholds to where you can kind of do a little bit. Some of them it's any. So it's really going to depend on the specifics of where you're selling. And so if you're going to start opening things up international, just be prepared to have some sort of way to track all that.
Okay. Um, you answered this, but I want to ask it again, just to like have it in this section. If I don't raise a profit and I just break even, or if I don't raise a profit and I lose money on the campaign, but it's successful, right? Like, because many times they don't budget, or a creator might not budget
Mhm.
correctly, and then they end up losing money. Do I still owe taxes?
It depends. You might. So that goes back to, like you said, you can spend money that may not be a deductible expense, or maybe it's deductible in a different year. So if you spent money on a campaign at the end of 2025 and it didn't fund until 2026, you may have already gotten the benefit of that deduction in 2025. And so even though you technically lost money, you're going to pay taxes on that in 2026. So it
Okay.
is possible to still have taxes and an accounting profit, even if you don't have an actual cash profit.
Okay. And then another one, this is a question using easy numbers, they say. If I raise 10,000 in my campaign and spent, this feels like an SAT question. Okay. If I raised 10,000 in my campaign and spent 5,000 on fulfillment and have 5,000 left over, do I pay my 15%
Hmm.
on the 5,000 or the 10,000?
Great,
I
great
like this
question.
question.
Yeah, no, good question. So you would pay that. So the 15% that we recommend setting aside for taxes, that would be on the 10,000. And the
Okay.
reason is because you're going to owe probably closer to 30 or maybe even 40% of the 5,000, the leftover. So instead of having you sit there and figure out what all those deductions are, we're just going to say, well, just do 15% of 10,000, and that's going to get you fairly close to 30 or 40% of the net.
Okay. That was a good one. I don't know who wrote
Yeah.
that, but that was great. What happens if I don't deliver rewards in the same tax year the funds are received? I don't, does that
So
matter? I like that. I mean, if,
it could possibly matter depending on how you track inventory specifically. So if the rewards are inventory heavy, let's say we're talking about books,
yeah.
and let's say you've decided that you're not going to do the cash basis for deducting inventory, you're going to do the accrual basis. That means that you're going to show the IRS, I have this much inventory on hand at the end of the year, but I'm not deducting those purchases. Then the next year, when you actually deliver the inventory, you're going to say, hey, I sold this much inventory now, and this is how much I've sold. And so now I'm going to deduct that inventory. Um, Typically, that's not how it goes. The default is it doesn't matter when you deliver it. The default is you pay taxes when the money's received. and you get the deduction when the money's spent.
Okay. Can I use Kickstarter income to pay myself? If so, how do I do it properly?
Yes. So I recommend planning for that in advance. If that's what you're going to do with the funds, if it's not going to be used to reinvest into the business and you want this to supplement your personal income, make sure you figure out what that percentage is. So I'd say like 50% and set that money aside. I actually set that money aside in a separate owner's pay bank account because I do everything through bank accounts. And you can, as easy as just transferring the money to your personal bank account. As a sole proprietor, you're not going to have payroll to yourself. You might have payroll set up and have employees and W-2s for other people, but as a sole proprietor, you're not going to have that for yourself. Instead, you're going to take what's called distributions. Taking those distributions does not change your taxes whatsoever. You're going to pay taxes on that income regardless of whether you distribute it to yourself or not.
Do I need, because I know we're a little over time, but I only got 3 more.
All
Do
right.
I need to collect and remit sales tax on digital rewards like ebooks or PDFs?
It's going to depend state to state.
Oh,
So
come on, Seth.
every
Give us
state
an
is
easier
different.
answer.
I know. Louisiana just passed a law saying that all digital goods are now also subject to sales tax, even though some digital goods were already subject to sales tax. I want to say Alabama maybe doesn't subject digital goods to
There
sales
you
tax.
go, Amanda. You're from Alabama. That's right, girl.
Don't take my word on that. I might have made that up.
Okay, made that up.
But yeah, so look at your home state first, see what the tax laws are there. And then if you do have sales in other places that would constitute economic nexus, then you have to look at those laws too, unfortunately.
Should I hire a CPA?
Well, yeah.
Should you hire Seth? Or can I manage taxes myself using TurboTax?
All right. So if you just have W-2s and some simple stuff, TurboTax is going to be good for you. But I don't care if I can tell a quick story about TurboTax. I had
Yeah.
a client, author client, come to us this year, and we were going to do their taxes. They decided that it was going to cost too much. They used TurboTax. They clicked 2 wrong things. One box that they checked off that they shouldn't have checked off, and they answered one question incorrectly following the TurboTax prompts. It cost them over $8,000 in taxes that they did not need to pay. And
Oh my
whenever
God.
they paid for the TurboTax Live support, and the TurboTax Live agent said, "Yep, looks right to me." And then they got a notice from the government saying, "You owe us this $8,000." And when they sent it to their little audit support team, the audit support team said, "Yep, just pay it. You owe it." They did not owe it. They just needed to go back and amend that tax return to check off this box here and take this number out from over there. And it saved them a ton of taxes. So you can use it, but if you don't know what you're doing, I wouldn't, you know?
Yeah, I mean, I think you scared everybody out of that, and now you'll be getting a lot of phone calls. I would agree. I think, I think we all do things well, and
Yeah.
if it's not necessarily something you don't do well, but it's this important and valuable to your business, hiring somebody makes the most sense. I'm with you on that. No. Um, is Kickstarter income considered self-employment income?
Yes.
Yes. Okay, great.
And I say that with an asterisk. If it's your business, and I guess part of your business is likely going to be considered self-employed income. So just like if you're an author and you have book royalties, if you're in the business of writing books, then that royalty income is still considered self-employed income.
Okay. What's the best way to prepare now to avoid surprise? This is the last one. Surprises next and new tax season.
I would say know your bookkeeping, like have all your stuff already separated, know where you stand today. Be setting aside money for taxes. You have not been setting aside money for taxes, at least start now, because even if you only get halfway there, that's half less you have to worry about later. And really sit down and look at your situation on what you expect to happen next year with your income, with tax rates, with the tax law changes, and see how it's going to impact you. It's all about
That's
being proactive.
proactive. I like that. That's our mic drop moment. Well, we are 5 minutes over. I'm sorry for that, but I am
It's
grateful
okay.
for you. This
Yeah,
was amazing. And we had some really good questions
I know.
in
These are
here.
great.
So I think that you're going to get a lot of people watching this at home later. So we tend to send this out the following week. So everybody who's joining us, and if you have any questions for Seth, you'll get all his information in the email follow-up, which would have the link to this webinar. So it'll be in the same place if you'd like to contact him. Do you have that last slide that you want to just throw up one
Yes.
more time? that has all your stuff on it. Sometimes people are more visual and they might have deleted the email at this point.
Yes, 1 second.
It also helps too when they're coming to our website, but we're very grateful for Seth being here today. And I know this isn't the sexy part of our business, guys, and or the fun part, because sometimes it's like, why do we have a business when we seem to be getting taxed all the time in every which way for it? But we know that our readers out there are very happy that we have it. So where to find Seth, authorcpa.com, which is a great website. Instagram, Norris CPA, and then norriscpafirm.com/newsletter if you want to sign up for his newsletter. But thanks so much, Seth. We really appreciate you. We love your wife. Please tell her we said that.
I'm a fan of hers too. I love her too.
You got a lot in common then. And we'll see you guys next month. We've got ads, running Kickstarter ads with Melissa Storm. So we'll see you guys in the next 30 days.
Thank you for having me, Dana. I enjoyed it.
Thanks so much. Bye, guys.
Bye-bye.